There's a massive trend quietly reshaping how millions of Indians are investing their money right now. It's a really strategic shift, and it's born out of today's kind of uncertain markets. So, in this explainer, we're going to break down exactly what's happening and why it might be super important for your portfolio. First, just look at this number: 8,928 crore rupees. I mean, wow. That is the staggering amount of money Indian investors poured into a single type of mutual fund in just one recent month. And get this, it wasn't a fluke. It's part of a much bigger pattern. So this leads us to the big questions, right? What exactly are these funds that are attracting record-breaking amounts of cash? And more importantly, why are they becoming the top choice for so many people right at this very moment? All right, let's dive in. Okay, first things first, let's establish the trend. This isn't just a one-month blip on the radar. Nope. Flexi cap funds have actually been the most popular equity category for 3 months straight. That shows a really clear and growing preference among investors. So what's behind this huge shift? Well, the answer is pretty much the world we're all living in. With markets swinging up and down and a whole lot of economic uncertainty in the air, investors are, getting a bit more cautious. They're looking for options that aren't just stuck in one rigid box. They need something that can actually adapt. And that's exactly where FlexiCap funds come into the picture. They offer a really powerful solution to this very problem. Their main superpower, as you can probably guess from the name, is flexibility. So let's get a crystal clear definition here. A FlexiCap fund is basically a mutual fund where the fund manager has the complete freedom to invest in companies of any size. We're talking the big, established giants, the growing medium-sized businesses, or even those small, high-potential startups. They aren't locked into fixed percentages, which is huge. It lets them pivot to wherever they see the best opportunities in the market. And this quote from Shweta Rajani just nails the appeal. With these funds, investors really get the best of both worlds. You get the stability that comes from those big, steady companies, plus the potential for some opportunistic growth from smaller, more dynamic ones when the timing is right. Now, what's really interesting here is how this all plays out in a real portfolio. Even though the managers can invest anywhere, they usually keep a solid core in large-cap stocks for that stability. You can see that's over 60% here. Then, they use the rest of the portfolio to strategically go after growth in those mid- and small-cap companies. Pretty smart. Okay, so that's the theory behind them. Now let's see how it's all working in the real world. Let's meet some of the top-performing funds that are really leading the charge in this category. Here are 4 of the heavy hitters. You've got the absolute giant, Parag Parek, which is the largest active fund in this space by a long shot. Then there's a super consistent performer like HDFC. And then you have funds like Aditya Birla and Capital Mind that recently delivered some really impressive monthly returns at 4.34% and 4.30%. All right, so we've seen the trend and we get the concept. Now let's talk strategy. How could a FlexiCap fund actually fit into your portfolio? What are the real benefits here? Well, experts usually point to 4 key advantages. First, you get protection during those volatile times, since managers can shift to safer stocks. Second, you have the ability to jump on growth opportunities wherever they pop up. Third, you're letting a professional make those tough calls for you. And fourth, you get instant diversification across all company sizes in one go. And this is the most crucial point, summed up perfectly here by Rajat Chandak. This strategy isn't just some short-term defensive move. The ability to play across the entire market, large, mid, and small cap, is what makes these funds potential powerhouses for creating wealth over the long term. So, how much should you actually think about investing? Well, the general consensus from experts is to consider an allocation of about 5 to 10% of your total equity portfolio to FlexiCap funds. This gives you that awesome adaptive advantage without putting all your eggs in one basket. And here's some really good news. This strategy isn't just for Wall Street wizards. FlexiCap funds are often seen as ideal for beginners, precisely because that professional management and diversification is already baked right in. Plus, they're incredibly easy to get into. You can start a systematic investment plan, an SIP, with as little as 500 rupees a month. Phew, we've covered a lot of ground, so let's just boil it all down to the essentials. What's the key takeaway you should really remember from all this? Here it is. In a nutshell, if you only remember 3 things, make it these. 1. Their superpower is being adaptable in shaky markets. 2.
They give you instant diversification across all company sizes. And 3, you've got a pro manager making the tough calls, trying to find that perfect balance between risk and reward just for you.
And that leaves us with a final thought to chew on. As markets get more and more complex and unpredictable, the old, rigid ways of investing are really being put to the test. This huge flow of money into flexi-cap funds, it suggests a bigger shift is happening, a shift towards a more dynamic approach. So the real question is, in a world of constant change, is the future of smart investing truly and completely adaptive?